The purpose of this video is to show how business cycles are very much influenced by the inventory cycles and how both of them eventually they influence financial markets like interest rates, inflation, bond yields, and the equity market. This chart is provided by the Bureau of Labor Statistics, and it shows the inventory to sales ratio. What this chart is showing is that the inventory to sales ratio has been rising steadily from 2014 to 2016. That, of course, is a concern for business because when inventories rise too rapidly relatively to sales, that's a cost that is being accumulated. And of course, they don't make any money because this inventory is not being sold. So what happens that during this period, as business recognizes that inventories are out of whack, they slow down production to bring inventories in line with sales. When this happens, like in 2016, then they start increasing production because sales are now growing faster than inventories. So during this period, with sales rising faster than inventories, of course, business increases production. Beginning in 2018, there is another upswing in the inventory to sales ratio, so you can expect business to slow down production during this period. So the inventory cycle is very powerful. Also, from another viewpoint, that when inventories are rising faster than sales, of course, this means that by cutting production, business needs less raw materials, it needs less people, and it needs less borrowing, which is called working capital. So the inventory cycle has a profound impact on these measures. This chart shows the same information, the inventory to sales ratio, but this time is the change in the inventory to sales ratio. But the message, of course, is the same. What this chart is showing that from 2014 to 2015, at the end of 2015, the inventories were rising faster than sales. So as inventory rises faster than sales, you can expect the business decision is, the common sense is to slow down production so that inventory do not accumulate. Then beginning in 2000, at the end of 2015, beginning of 2016, the inventory to sales ratio, inventory started slowing down relative to sales. So of course, business decision is to increase production to replenish inventory so that they could meet sales. And here in this period, inventories and sales were growing at the same pace. However, in 2018, inventory started growing faster again relative to sales. And of course, you can expect that industrial production slowed down because that was the business decision. So why is this chart important? First of all, because I think the business cycle is driven by business decisions. Sometimes the people get confused with the Fed, the policy, the government, the agencies, and the parties. But the bottom line is this changes in business activity, slow down in production, increase in production, slow down in productions. They're all business decisions to minimize cost and take advantage during periods of inventory accumulation and ramp up production when sales start picking up. Now, and obviously, as you will see, these changes in business cycles have tremendous importance in how much business buys for commodities, how much they borrow, and how much people they hire. That's called working capital. And that's what is driving the markets. And this is what happened to industrial production. So in this period between 2014 and 2015, we saw before that the inventory to sales ratio was rising. So business made a very rational decision, which is, okay, we got to cut production because inventories are out of line with sales. Then the inventory to sales ratio started declining again, meaning that sales are rising faster than inventories. And then, of course, business made the rational decision of increasing production between 2015-16 into 2018. But then what happened here in 2018? As I mentioned before, as I showed in the previous chart, the inventory to sales ratio started rising again. So beginning 2018, the business decision, very rational, to cut cost, started reducing production. Again, I want to remind you that this changes, that no one is really talking about it. They're business decisions, and business decisions have an impact on commodities, on interest rates, in the financial markets, as I will show you. What I have done is to develop, it took me several decades to get to this point, is a real-time indicator that I can compute every day. And it tells me the position of the business cycle. So in previous slides, I showed you how the economy strengthened, or the business cycle pointed up with the inventory slowing down, but the economy strengthened, industrial production accelerated. Then here in 2014-15, there was a slowdown. I showed you how the industrial production strengthened from 2015 to 2018, and how beginning in 2018, again, the inventory to sales ratio was running unfavorably and pointing to a slowdown. So this line really shows strengthening, weakening, strengthening, and weakening of the economy. Just to give you an idea how powerful this business cycle is, then notice that when the economy slows down, the stock market really doesn't do very much, like in this period and in this period. This doesn't mean that every time the business cycle slows down or declines, the market is going to collapse. There are periods, and again, this is the subject of other videos. I don't want to make this video too long, is that during these periods, some stocks do poorly, but other sectors do very, very well. So the importance of this curve is not only to tell you roughly there is market uncertainty, but it is also to tell you this, to shift investment strategy from some sectors to other sectors, so aggressive sectors and defensive sectors. I will spell it out in detail in future videos. So this real-time business cycle that we developed is a very important strategic tool to develop an investment strategy. All these concepts are developed in the Peter Duck Portfolio, a publication that twice a month, and then in my 3 books. There's detail on how look at the business cycles and what kind of portfolios are likely to perform well during the various phases of the business cycle. Again, thank you very much for looking at this video, and follow me on other videos that I will make and show you how to build a portfolio using these concepts of business cycles and financial markets. Thank you, and looking forward to seeing you very, very soon.